Chapter 3, we will continue job order costing system and focus on cost flows and external reporting. Learning Objective 1 is to understand the cost flow in the job order costing system and prepare appropriate journal entries to record costs. Learning Objective 2 is to use T accounts to show cost flow in the job order costing system. And we will learn those two objectives together through the process. First, let's define some accounting terms in the process. Number 1, raw materials. Raw materials include any materials which go into the final product, including both direct and indirect materials. Number 2, working process. Working process consists of units of production which are only partially complete and will require further work before they are ready for sale to customers. Number 3, finished goods. Finished goods consist of completed units of a product which have not been sold to customers. Here, in merchandise companies, on the balance sheet, there is only one inventory account, which will be reported as a current asset on the balance sheet. However, in manufacturing companies, because manufacturing companies produce products themselves and then sell products to customers, so on the balance sheet of manufacturing companies, there are 3 inventory accounts, 3 sub-accounts: raw materials, working process, and finished goods. It's a little bit different from merchandise companies. Number 4, cost of goods manufactured. Cost of goods manufactured includes manufacturing costs associated with goods which are finished during the period. Number 5, cost of goods available for sale. Cost of goods available for sale include manufacturing costs associated with goods which are ready for sale during the period. In Intro to Financial Accounting, remember you learned inventory equation, beginning inventory plus purchases, and you'll get cost of goods available for sale. That's the term here, same. But just the difference between merchandise companies and manufacturing companies. Inventory account is a little bit different. Again, in merchandising companies, there's only one inventory account. But for manufacturing companies, there are 3 sub-inventory accounts: raw materials, working process, and finished goods. Cost of goods sold. Cost of goods sold include manufacturing costs associated with goods which are sold during the period. In other words, when goods are sold, the cost of goods becomes cost of goods sold. Cost of goods sold is an expense account. This is a picture. It shows different stages and the cost of production. From the materials and the supplies used in the production, and then working process here, and after products are produced or finished or completed. When products are completed or finished, product costs will be recognized under finished goods inventory account, which is reported on the balance sheet. After goods are sold, the cost of finished goods will be transferred to cost of goods sold, which is expense, and reported on the income statement. We will take a look at the whole process in detail. Let's overview the flow of costs in the job order costing system. When a company has purchased materials, material cost will be recognized as raw materials in the raw materials inventory account on the balance sheet. When raw materials are used in production, their costs are transferred from raw materials inventory account to the working process inventory account. those unused materials will be remained in the raw materials account. For direct labor costs are added directly to work in process when costs are incurred. Manufacturing overhead costs are applied to work in process inventory account. The application process is what we've learned in Chapter 2. We will use the predetermined overhead rate multiplied by the actual quantity of the allocation base used by each job, and we can get applied manufacturing overhead cost and apply this to work in process account. When goods are completed, their costs are transferred from work in process to finished goods inventory account. When goods are sold, their costs are transferred from finished goods to cost goods sold. Keep in mind, cost goods sold is expense account, which will be reported on the income statement. The amount transferred from work in process to finished goods is called cost of goods manufactured. For non-manufacturing costs, selling and administrative costs, they are periods costs, and they should be recognized as expenses immediately. Let's take a look at the transactions in key account and journal entry form, which capture the flow of costs in the job order costing system. Those are T accounts. You've learned T account in Intro to Financial class. Let's review a little bit for T account, debit credit. Based on the accounting equation, assets equal liabilities plus shareholders' equity. Assets increase, we debit. Assets decrease, we credit. The opposite for liabilities and shareholders' equity. If liabilities or shareholders' equity accounts increase, we credit. Decrease, we debit. Okay, now let's take a look at the whole process. When the company has purchased the materials, we debit raw materials. Keep in mind, this is inventory account. This is asset. So asset increases, we debit. We debit materials purchases. We credit payable account or cash. Let's assume the company does not pay cash, but just liability, so we should credit accounts payable. When direct materials are used, we decrease raw materials, so we credit raw materials. We debit work in process and record it on the job cost sheet, which we've learned in Chapter 2. So the journal entry here, we debit direct materials cost to work in process, and we credit raw materials. For indirect materials used in production, such as supporting supplies, lubricants, we reduce raw materials, so we credit raw materials. But we debit manufacturing overhead. So you can see here, we debit indirect materials cost here under manufacturing overhead, and we credit the amount under raw materials. Let's take a look at a specific example here. On October 1st, Smith Corporation had 5,000 in raw materials on hand. During the month, the company purchased 45,000 in raw materials on account. On account, this is a typical term in accounting, which means there's no cash involved, no cash paid, no cash received. So here, the company purchased 45,000 in raw materials, but did not pay cash yet. For T account of raw materials, we have a beginning balance on the debit side, 5,000. The company purchased 45,000, so we debit 45,000 under raw materials, and we credit payable account. The journal entry here, we debit raw materials 45,000 and we credit accounts payable 45,000. On October 3rd, Smith had 43,000 in raw materials, requisitioned from the storeroom for use in production. These raw materials included 40,000 of direct and 3,000 of indirect materials. So we have beginning balance here for raw materials 5,000, purchased 45,000. Now, direct materials used 40,000, indirect materials 3,000. For direct materials, we credit raw materials for 40,000, we debit work in process. For indirect materials, we credit raw materials 3,000 and we debit to manufacture overhead. The journal entry here, we debit work in process 40,000 for direct materials, debit manufacture overhead 3,000 for indirect materials, and we credit total raw materials 43,000. Labor costs. When direct labor costs are incurred, we debit work in process and record it on the job cost sheet. We credit salaries and wages payable. We assume the company has not paid cash yet. For indirect labor, when indirect labor cost incurred, we debit manufacture overhead and we credit salaries and wages payable. Let's take a look at the example. During the month, the employee time tickets included 35,000 of direct labor and 12,000 for indirect labor. For direct labor, we debit work in process and we credit salaries payable. For indirect labor, we debit manufacture overhead and we credit salaries payable. 35,000 plus 12,000, you will get 47,000. So total credit side to salaries payable is 40,000. The journal entry here, we debit work in process 35,000, manufacture overhead 12,000, and we credit salaries payable for a total 47,000. In addition to indirect materials and indirect labor costs, manufacturing companies may incur other manufacturing overhead costs, such as depreciation, insurance of manufacturing facilities, or utilities. Those costs should be debited to manufacture overhead. And the credit side are different accounts, such as payable accounts or accumulated depreciation. Let's take a look at the example. During the month, the company incurred the following actual overhead costs: utilities, heat, water, and power, 1,700. Depreciation of factory equipment, 2,900. Property taxes payable on factory, 1,000. Total here, 5,600. For those other manufacturer overhead costs, we debit manufacturer overhead, and we credit the payable account, and for depreciation, we should credit accumulated depreciation. So the journal entry here, we debit manufacturer overhead, 5,600. We credit utilities payable, 1,700. Accumulated depreciation, 2,900. And property taxes payable, 1,000. Let's take a look at quick check question. What costs are used to determine product costs? In Chapter 1, we learned product costs include direct material, direct labor, and manufacturer overhead, MO. In Chapter 2, we learned how to calculate MO costs using predetermined overhead rate. We use predetermined overhead rate multiplied by actual level of allocation base to get MO cost. This is a way to calculate applied MO. So here, product costs include direct material, direct labor, and applied MO, not actual MO. Let's continue. Take a look at how to apply MO cost. When we apply manufacturer overhead to a particular job, we debit work in process and record it on the job cost sheet, and we credit manufacturer overhead account. Let's take a look at the manufacturer overhead. This is the T account of MO. The left-hand side shows actual amount of MO. So we debit indirect materials, indirect labor cost, and other MO cost incurred for the company. Those are actual amounts. For applied amount, we use predetermined overhead rate multiplied by actual level of allocation base, and we credit to MO account here. So right hand side shows the amount of applied MO. In our real life, normally, actual MO will not be the same as applied MO. And at year end, we will do the adjustment. We will talk about in details later. Let's take a look at our example. Smith uses a predetermined overhead rate of $3.50 per machine hour. During the month, 5,000 machine hours were worked on the jobs. To calculate applied manufacturer overhead cost, we use a predetermined overhead rate $3.50 multiplied by actual level of allocation base. The allocation base here is machine hours. So 3.50 multiplied by 5,000, and you will get 17,500. This is applied MO cost. We debit 17,500 to work in process and credit manufacturer overhead account. The journal entry here, we debit work in process and we credit MO for 17,500. Here, keep in mind, we have total on the left-hand side, which is the amount of actual MO for the company. And we have right-hand side applied. Right now, left-hand side actual amount is more than right-hand side by 3,100. And we'll go back, take a look at this number later. As a job is completed, its costs are transferred from the work in process inventory count to finished goods inventory count. The amount transferred from work in process to finished goods is called cost of goods manufactured for this period. Let's continue our example. During the period, Smith completed jobs with a total cost of $27,000. So we need to transfer $27,000 from work in process to finished goods. The journal entry here, we debit finished goods and we credit work in process. When the finished goods are sold, then we need to transfer the cost from finished goods to cost of goods sold. The journal entry here, we debit cost of goods sold, and we credit finished goods. Keep in mind, finished goods is inventory account, but cost of goods sold is the expense account, which should be reported on the income statement. Smith sold $27,000 in finished goods inventory to customers for $43,500 on account. You can see we see the term again, on account. On account means no cash received, no cash paid. Smith uses perpetual inventory system. Well, in Intro to Financial Accounting, you've learned two inventory systems. One is perpetual and the other is periodic. For perpetual inventory system, if the company has sold products, we will recognize two journal entries. One is to recognize sales. Second is to recognize decrease of inventory and increase of cost of goods sold. But in a periodic inventory system, the company will only need to recognize one journal entry, sales, and not recognize decrease of inventory or increase of cost of goods sold. So here, Smith uses a perpetual inventory system, and for a sale transaction, we will make two journal entries. We need to recognize our sales at selling price, $43,500. So we debit accounts receivable because the company sold products on account, no cash received yet. But the company will receive cash later, it's accounts receivable. And we credit sales for $43,500. The other journal entry is to recognize the transfer cost from finished goods to cost of goods sold. We debit cost of goods sold, and we credit finished goods at $27,000. For non-manufacturing cost, non-manufacturing costs incurred in the manufacturing company are not assigned to individual jobs, and they will be expensed immediately as period costs. For example, salaries expense of employees who work in the marketing, selling, or administrative capacity. Advertising expenses, they are all period costs and should be expensed immediately. Let's take a look at an example. During the month, Smith incurred but has not paid sales salaries of $2,000 and advertising expense of $750. We should recognize both as expenses and credit payable. So we debit the sales expense $2,000. We debit advertising expense $750 and credit salaries payable and accounts payable respectively.